Given the current tensions in the Middle East, many conversations I'm having with my clients revolve around asset protection in times of geopolitical uncertainty. Many families and entrepreneurs are starting to think more seriously about what would happen to their wealth if the situation escalated even further. So I decided to make this video and share the framework that we use at Lepidus Wealth when we are designing long-term asset protection strategies for our clients. Now, many of the tools in this framework are not new. We have been using them to protect our clients from legal disputes, business conflicts, divorce situations, and succession planning, as well as cross-border estate issues. However, some of the steps that previously felt optional or something only ultra-high net worth families would consider are now becoming sensible precaution measures to take. Now, this video is not about reacting to the current situation in real time. Current events are still unfolding, and we can all hope that the tensions de-escalate and stability returns to the GCC region as quickly as possible. Instead, in this video, I will try to explain how to design a long-term wealth protection structure that can withstand geopolitical uncertainty. We will explore strategies that wealthy families and businesses were able to use to protect and grow their wealth, even through major conflicts such as the World War I and World War II. This includes examples such as the Rothschild family, the founders of Lego, and the family behind IKEA. Their survival was a result of careful planning, diversification, and strong ownership structures. So we are going to discuss the blueprint for generational asset protection against uncertain geopolitics. And within this blueprint, on a long-term horizon, I do see Doha and Dubai as politically stable wealth centers in the region, alongside other centers I will mention in this video such as Switzerland, Singapore, and Hong Kong. The goal here is diversification not only of investments but also jurisdictions, currencies, banking relationships, and legal structures. Another important point is that many of our clients have wealth spread across different parts of the world. For example, a client may have $2 million of assets in the UAE, but a global net worth of 12 million US dollars. So while working with our clients, we may start by protecting the assets located in the UAE. However, the strategy usually expands to cover the entire global balance sheet. So from that aspect, this video is really not a regional wealth protection guide, but a generational wealth protection guide. Now, one final note before we go further. Most of the strategies I will discuss in this video typically make sense for families with a net worth of around 5 million US dollars or more. If your net worth is lower, for example, around 2 million US dollars, many of these structures may not make logistical sense or justify the cost. So your personal plan would usually be a much simpler version of this strategy. But understanding the full framework will still help you see how sophisticated families think about protecting wealth across generations. Before we start, my name is Shiraz Waheed and I'm the co-founder at Lepidus Wealth, where we help high net worth families and entrepreneurs with asset protection and legacy planning. So if you would like our help with the same, you can request a personalized asset protection plan by clicking the link in the description below or reach out to me directly through WhatsApp. I would also request you to subscribe to our channel to benefit from our weekly videos as well as help us grow this channel further. Now, starting with the first consideration that you need to make is jurisdiction diversification. Wealth should not depend entirely on one legal and political system. If all your banking, property, and investment sit inside of one country, the legal and political risk of that country automatically becomes the risk of your entire balance sheet. International families normally distribute their assets across multiple stable jurisdictions. Financial centers such as Dubai, Switzerland, Singapore, and United Kingdom often form part of this structure. Each jurisdiction operates under its own regulatory environment, banking infrastructure, and legal system. This does not eliminate the risk entirely, but it reduces dependency on single political environment. When assets are spread across multiple jurisdictions, geopolitical disruption in one region does not automatically freeze the entire structure. The next consideration that you have to make is diversifying banking relationships. Many successful families and entrepreneurs maintain their primary liquidity in one banking system because it is convenient for daily operations. But during geopolitical disruptions, banking systems are often the first place where restrictions appear. Capital transfers may be limited, compliance reviews may increase, and international transfers can face delays. Now, wealthy families usually maintain bank accounts in more than one financial center. For example, they may have one bank in Switzerland, one in Singapore, and another one in the UAE. If one banking system becomes restricted for a period of time, they can still access liquidity through their other banking relationships. Another important element is ensuring that part of your wealth is portable. Certain assets can move internationally with very little friction, while others are geographically fixed. Real estate, for example, is immovable by definition. A property may remain valuable, but it cannot be relocated if circumstances change. In contrast, internationally custodied investment portfolios, precious metals stored in recognized vaults, or certain digital assets can be transferred across jurisdictions more easily. Families that do consider geopolitical risk often maintain a portion of their wealth in assets that are internationally transferable. The objective here is to create flexibility, so if you ever need to relocate, your capital can move with you more easily. Custody of your investments also matters. Many investors keep their portfolio with local brokers because that is where the relationship started. But local custodians must follow the rules of the country where they operate. If that particular country introduces capital transfer restrictions or financial control, the custodian must comply with those rules. International custodians add another layer of resilience. Global brokers and private banks in major financial centers can hold investments under international custody structures. For example, wealthy families store part of their wealth as physical gold in jurisdictions such as Switzerland. When clients acquire precious metals at this scale, the gold is typically stored in professional vaults under insured custody. This is very different from storing gold personally. Professional vault providers and private banks offer secure storage, insurance coverage, and proper reporting for long-term generational custody. Holding gold in a stable jurisdiction such as Switzerland can provide protection against risks such as banking system disruption, currency crisis, or temporary capital control. Now, because of the increased requirements from my clients, I will be in Switzerland personally this month and parts of the next months. So if you are someone considering diversifying and are open to investing at least $1 million or more in physical gold, I can personally accompany you and help you acquire and store physical gold in secured vaults in Switzerland. Another structural decision is positioning part of your wealth within the globally recognized financial centers. Certain financial hubs have historically remained operational during periods of geopolitical uncertainty. Places such as Dubai, Zurich, and Singapore were designed specifically to attract international capital and provide stable legal framework to cross-border wealth. Now, Dubai in particular has developed regulated financial environments such as the Dubai International Financial Center or the Abu Dhabi Global Market. These jurisdictions operate under internationally recognized legal frameworks and independent regulatory systems. For many families, this is where tools like family foundations can be established. Foundations in jurisdictions such as DIFC or ADGM can hold assets and manage them across multiple countries while remaining connected to international banking system as well as investment ecosystem. Now, ownership separation becomes another important layer. Assets held directly in personal name remains legally connected to the individual owner. International families often separate ownership through legal structures such as foundations, holding companies, or trust. Within Dubai, DIFC and ADGM foundations have become widely used tool for this purpose. A foundation is a legal entity designed to hold assets under a defined governance framework. Instead of shareholders, it operates under a charter and governed by a council. While the founder defines the governance rules, the foundation becomes the legal owner of those assets that guide how those assets are managed. This separation can create long-term continuity. It also allows assets to be managed across jurisdictions with clear governance structures. However, timing in these cases is important. Structures that are implemented after disputes or financial stress can face legal challenges. Proper planning should happen well before any issue arises. And here at Lepidus Wealth, as authorized corporate service providers, we assist our clients with full implementation of family foundations, holding structures, and family office frameworks in Switzerland as well as in Dubai. Another structure used in international planning involves insurance wrappers, often referred to as private placement life insurance. In this structure, an investment portfolio is placed inside an insurance policy issued by a regulated insurance company. Legally, the asset becomes the insurance policy itself, while the underlying investments remains professionally managed within the policy. These structures are commonly issued from jurisdictions such as Luxembourg, Bermuda, and Singapore. They are used for estate planning, cross-border tax coordination, and long-term wealth consolidation. The objective for such insurance policies is not the total tax elimination. Tax treatments always depend on the residency and domicile of the policyholder. However, planning investment portfolios inside an insurance wrapper can provide structural advantage because insurance contracts operate under a different legal framework compared to owning those investments traditionally in your own personal name. Life insurance is another component that many families include in their wealth protection structure. Unlike other assets, a life insurance policy creates a defined pool of liquidity that is paid to the family upon death. This liquidity can be important during generational wealth transfer. It can help cover inheritance taxes, provide immediate funds to the next generation, or prevent the forced sale of assets such as business or property. For many families, life insurance work alongside other structures. While foundation and investment portfolios hold and grow the wealth, the insurance policy provides liquidity when succession actually occurs. And here at Lepidus Wealth, we do specialize in high net worth life insurance as well as insurance wrappers through our relationships with international insurance providers. And that is something we can certainly help you with on your journey to asset protection. Now, personal mobility is another important factor. If you cannot travel or relocate, accessing assets in other countries can be difficult. For this reason, many families maintain residency in more than one country. Some also obtain second passports to ensure they have the legal ability to relocate if necessary. Access to banks and financial centers often depend on your ability to travel or to reside in those jurisdictions. Mobility therefore becomes an important part of long-term wealth planning. Now at Lepidus Wealth, we also assist our clients with second passport programs through end-to-end advisory solutions where it's needed. Now, finally, the currency diversification should not be overlooked. During the geopolitical crisis, currencies can experience rapid devaluation or exchange controls. If wealth is concentrated entirely in one currency, purchasing power becomes tied to the monetary policy of that country. International investors typically diversify currency exposure through global investment portfolios and account denominated in multiple currencies. This does not entirely eliminate the currency volatility, but it spreads risk across several monetary systems rather than relying on just one. So when all of these elements are coordinated together, wealth becomes less dependent on a single country, a single banking system, or a single legal structure. The objective is to create continuity. Wealth should remain operational across jurisdictions even during periods of geopolitical uncertainty. So if you would like our help in designing a structure like this, you can request a personalized asset protection plan using the link in the description below. And if you're worried about the current geopolitical situation and looking for more clarity, you should check out my next video on what happens to your bank accounts during the war right here.